All right, Quasar Markets Live. Kevin Green, y'all love him. He's been out a little bit, running around the world, trying to tell us what's going on. And look, Kevin, it's chaos, and a little bit more chaos. And it seems like people love chaos. Is that right?
Yeah, the market likes chaos at this point in time. I think what you've actually seen over the last week is a little bit of a different structure than what we've seen over the last 3 to 4 weeks, Stephen. 3 to 4 weeks ago, we were kind of looking at this broadening out trade, and in some respects, that's still kind of holding up in certain pockets. But you're starting to get a little bit more attention back into those Mag 7 names as we prepare for earnings, and that's where the relative strength has actually seen some outperformance, especially over the last couple of days. You had Microsoft catching a pretty decent bid. Meta doing the same. Now, obviously, we have earnings today that's going to kind of shake it up here a tad bit. But I think we're just kind of seeing that rotation back into communication services, back into technology. I think that lasts for the next couple of weeks here. And I still believe that we will see a pretty decent re-rating and volatility higher for the VIX over the next 2 weeks. It looks like those signals are starting to come to fruition here. Looking at a weekly chart on the VIX, and I actually like putting a MACD on it. Now, I'm not a fan of putting technicals on the VIX. I know that that's a no-no, and somebody's going to put it in the comments that what are you talking about? But if you put the MACD on the VIX, MACD, that bullish or bearish cross at 12 EMA above the 26, especially on the weekly chart, has been a pretty
Yeah.
decent forward-leading indicator. I'm not saying it's absolutely going to happen, but it seems like we're kind of preparing for that bull cross for volatility. Actually, I believe it crossed today, if I'm not mistaken. So
Yeah,
keep your eye out on that in the next 2 weeks.
let's talk about that a little bit. Let's kind of mix them all in. Let's make this a little more chaotic, I guess, in a way. Make the theme a little more clear. Earnings just came out. Mixed earnings. Meta just said, the CFO just said average ad prices were up 6% year over year. This guy in the Federal Reserve, this guy named Powell, came out today and he said, things are not as bad as everybody thinks it is. It's okay. And jobs are not that bad. There might be some problems with AI. Maybe some job losses there, but they're okay. We saw the numbers of consumer confidence bad. He says the consumer is still spending money. And ad revenue is up. And silver and gold making all-time highs. What in the hell is going on, Kevin? I mean, this doesn't make any sense. Look, we're old school here. I'm old school. This doesn't make any sense to me whatsoever.
Yeah, there's definitely a different narrative in certain pockets of the market. I would agree with you there, especially when you're looking at some of this enthusiasm. So if we kind of take it step by step, the consumer confidence data kind of falling off a cliff here. That's across all political affiliations, and I know there's people that have been kind of poking at that number or that data set over the last couple of years. But even if you take the Democrats out of it, if you take the independents out of it, even the core of the party is still seeing maybe some weakness there. And it's not so much the fact that maybe it's inflation. We are seeing kind of those pressures being reflected in that data or that report. The concern right now is about labor hiring as well as wages moving forward, and that might be fueled by artificial intelligence. So now let's go into another chaotic topic here. AI is really fueling the growth for Meta. We continue to see that. They are seeing the efficiencies and the ability to pinpoint with really good precision their ads to the right consumer. And then you also have those enterprise companies, enterprise customers spending money on that. And that's why they're seeing expansion in margin. So that's going to be a tailwind for them. I think the wild card that you do see in this earnings announcement, not only just for today for Meta, but also for Microsoft, is the increase in CapEx spend. But it's a little bit more unique this time around, Stephen, than what we've seen in the past. These lease agreements, these lease and finance agreements for these data centers is starting to actually have an immediate impact on their balance sheet. And that might be something that's short-lived, but I think it might catch a couple of people off guard. If you look at Microsoft earning announcement, which was actually pretty decent, the CapEx number blew back past the street's expectations, and that's why we saw the stock moving to the downside here. And for Powell, he's right. Consumer continues to spend in some respects. Confidence isn't that great. Productivity gains are actually probably accelerating a lot more and a lot faster than anybody expected when it comes to artificial intelligence. And that's going to be a net positive for these businesses in order to expand their operating margins. So there's a lot there. And I think each pocket is telling its own story. Now, gold and silver, is kind of having its own little episode. Geopolitical risk, Fed's buying, Federal Reserve banks and central banks buying up some of those assets. You also have the retail flows that are taking place there, and you're just seeing a little bit of a price shock to the upside. Liquidity is drawing down on those markets, and that's also why we are seeing that price action. So I want to be mindful to tell people, because a lot of has happened in the commodity space. I know I'm all over the place, but I want to kind of bring this all together. Liquidity in the commodity markets is drying up in certain pockets.
Okay.
Metals is being one of them. Energy, in some respects, not crude oil, but if you're looking at natural gas, that was the same type of move that actually happened there as well. When you have liquidity in markets, you get outsized price moves, either to the upside or downside. And even for silver, we're seeing these 8%, 10% range days, which is out of the ordinary, and usually the sign of a potential topping pattern that does take place. Now, can gold actually sustain these current prices? They can. It can, because it's a very unique type of asset. I mean, I think if you're going to break the gold fever, it's going to have to come from an announcement from a central bank that says that they're going to stop buying, and or they're going to raise some cash because they have to backstop their currency. Japan kind of comes to mind, but we won't even get that far ahead. Also a liquidity drain. The options for silver, there was a major options expiration today for silver as well. So that also is going to lead to a little bit of this volatility. So I think each and every pocket has its own little story here. But I would be a little bit more concerned. There's a mania that's definitely happening in the metal space, but be very cautious about that at these current levels. It can continue to run and be aggressively, pushing price to the upside here. But you are seeing some pockets where inventory levels are starting to stack up pretty aggressively. Copper is doing that right now. The copper move continues to move higher. But if you look at COMEX inventory levels, LME inventory levels, even China inventory levels, they're actually stacking up. And then there's concern about companies actually trying to purchase a lot of those industrial metals at these current prices. I think it's going to be demand destructive over time. We're just not there yet to see that reaction.
Yeah, supply seems to be way up for the demand. I mean, I understand that the whole thing about Elon Musk saying solar panels on the moon or whatever he's going to put them out. You need all the silver in your phone. I get all that, but the supply is meeting demand. The price is just at some point these companies will be like, hell no, I'm not going to pay this price.
Yeah. At some point that will happen, especially if you're looking at silver. So silver is an industrial metal first, precious metal second. You know that, Stephen, right? 50% of the demand for silver is industrial. And at some point in time, when prices get too outstretched, it's going to have an impact on the overall demand for the industrial sector as a whole. And either they're going to have to pass those prices on, which means that prices go higher for a lot of those industrial goods, because silver is more of like an introductory or even an intermediate type of input item for a lot of products and services, products, right? Or you're going to see those prices kind of get pushed towards the consumer or whoever the end user is, or you're going to see them kind of pulling back when it comes to the consumption. Once again, we are not there yet. But you are seeing some earnings announcements that are kind of talking about this. We had, who was it the other day that actually reported this? I think it was GE. Actually, it was this morning, right? GE Vernova talked about some of the input prices, or GE Aerospace talked about the input prices actually moving higher. So it wasn't GE Vernova, two different companies. GE Aerospace talked about higher input prices and how that's going to have an impact on the near term when it comes to their supply, and they actually could be pulling supply or inventory back out of this market here in order to stabilize their operating margin. So you're starting to hear some of those cracks coming in. And once again, this is a cycle. We are in a commodity. Ooh, I hate saying it like that. Let me pull back. We are not in the commodity cycle yet. There's a lot of people. Yeah, well, the reason why I'll say that, a lot of people are actually showing this Bloomberg commodity index, that's kind of moving to the upside here. But we're not in actually a commodity cycle by any stretch of the imagination. If you think about it, there's only one pocket of the market of the commodity space just in general that's actually catching a significant bid that's outpacing the other commodities. Energy is not really doing that much. Take natural gas out of it. Natural gas had an event, and it will normalize at some point in time. Those spreads are starting to come in. As we have seen the contract for the February natural gas prices contract actually kind of rolling off today.
I will say
go ahead.
Sorry. I will say that the one commodity that I have been calling for the last month or two has been FCOJ, frozen concentrate orange juice, and that thing has gone through the roof because of cold weather, obviously, in Florida, and Brazil, obviously, being the other part of that. So that was a triple trifecta there for FCOJ. All right, let's get to it. Other side from the White House going down to the Federal Reserve today. And interestingly enough, he did not want to talk about him leaving.
Yeah.
Didn't want to talk about the political side thing smartly, right? All right. So Trump says he's got 4 people on the burner that he knows is in. Now, 2 months ago, Trump said the next person to be the Federal Reserve chairman is in this room. Kevin Warsh was in that room and Kevin Hassett was in that room. There are now 4 people in the running, and neither one of them are on the top 4 in Kalshi or anything else. Rick Reeder's got 2 buttons, I guess, missing from the top of his shirt because he can't seem to put them together. Who is the next Fed chair?
Look, leave Rick. I actually like I actually like him, man. He's actually really good.
Me too. I like his style.
I don't know. I don't know. I think President Trump is looking for obviously the right candidate for him, and I think right now the balance in the question mark is the person that he's going to be able to pick going to do exactly what he wants them to do, he or she, and then is that person also going to be easily confirmable without any headaches or issues? And I think that's right now what the holdup is, and it's always a 2-week thing. And, we won't get into politics of that, but I think that's really the back and forth that we are seeing is, hey, there's some pretty decent candidates, but who could I put in there where the market respects, but also will do what I would like for that individual to do? And it's a very hard balance, and it's not unique to President Trump. It's all presidents have done it, right? I want to be balanced, but I think there's if you look at a couple of those names that are on that list right now, I think the market does have some confidence in them. I think that's where you kind of maybe have President Trump might be a little bit more concerned that they might deviate from the stated plan during their interviews and causing a little angst here. The yield market and the dollar market, though, is a little bit concerning to me, regardless of whoever the Fed chairman is going to be in the future. The price action in both, I think, is kind of signaling that there might be some greater systemic pressures that we are seeing on the international front. You can see that within the currency space. Now, the dollar index, I think, actually came down and kind of aggressively got a little bit oversold. I would not be surprised from a technical standpoint if you actually do see a rebound back to around that 98 and a half level before we continue to proceed lower. And this is kind of tracking exactly what we saw in Trump's first administration. They would like to have a weaker dollar in order to boost exports. I think the big wild card question is there going to be demand for those exports? And we don't know because we are seeing a transformational shift when it comes to our portfolio here in the United States as far as manufacturing and services. So I think that's one to keep on the radar there, that dollar move. The yield space, Stephen, if you think about it, every single Fed meeting that we've actually had a cut, the 10-year Treasury yield is actually higher the next 30 days, and I think that's not a really good sign.
Expect it to be down tomorrow, then, I guess.
Yeah, well, we will see. I'm not sure. I think the market is going to demand for higher yields for duration. I mean, there's a lot of uncertainty that is out there, and if you think about it, it's not a crazy thing to think about. If you go back the last 20 years, 30 years, there was a significant premium on the long end of the curve. That actually just went away basically after the financial crisis. That went away. So those spreads are really normalizing here. Is the broader equity market okay with these pricing models that have been used to modeling out the last 15 years, 20 years, going back to now resetting to a regime that we've been in, 30 years ago, where those spreads are a little bit wider, people demand a little bit more premium for the risk and duration that they're taking.
Yeah. All right, Kevin Green, Schwab Network, my friend. Let's do this again next week, man. We'll see you again.
Appreciate you.